3 out of every 1,000 deposits ever become producing mines. It's a harsh reality, but it's the truth. Mining is a profession. It requires people skills such as leadership, charisma, networking expertise, the ability to raise funds, assemble a team, deal with local authorities, master budgeting, understand commodity cycles, know how to automate and create modern business procedures, and it ultimately requires having courage, commercial sense, passion, and a contrarian outlook. That's why looking for an entrepreneur who possesses these skills is the first part of the due diligence period that you must conduct in order to capitalize on natural resource wealth. It's easier than you think. Success leaves clues, as Tony Robbins says. First quantum, first majestic. One man is behind the mega success stories of these billion-dollar businesses, Mr. Keith Neumeyer. His newest billion-dollar candidate is First Mining Finance, the only mineral bank in the Northern Hemisphere. He has also taken sizable positions with Zinc One, Silver One. Keith has made ordinary investors millions of dollars. He is the millionaire maker. His newest venture could be your ticket to wealth. Go to wealthresearchgroup.com/Keith2017 for an in-depth breakdown of the intrinsic values of his companies. Welcome to the Titans of Industry show. Today I have one of the legends of the natural resource sector. You can't miss U.S. Funds founder, Frank Holmes, if you've been in and around this industry for long. He's a keynote speaker in the major mining conferences, a regular on Kitco, and many influential financial media outlets. I'm happy you could join us today. Frank, you're probably excited about going to ring the opening bell next week. How are you?
I am, and it's just great, and it's just the perfect timing. The GDXJ is truly unraveled. You know, they took a year to accumulate $5 billion in gold fund and gold assets, and they're blowing them out, $3 billion in 6 weeks, and that's really damaged a lot of high-quality companies. And myself launching this smart beta, as some call it, or I like to call it my quant ETF. It's just at the first perfect buying time, right at the bottom.
Well, I went through the prospectus, and I'd love to share this with our audience throughout the interview. I want to start off with, in retrospect, what do you think, in your opinion, brought the surge in gold and silver stocks back in in the first 8 months of 2016?
I think there's several factors, and one is they got their costs under control. So there was a lot of write-downs and refinancings, and a lot of companies had costs that were pushing $1,500 an ounce, and they got them under $1,000 an ounce. And as gold started to move, then their profit margins start to jump dramatically. So let's say your cost is $1,000 production, and gold is $1,100. You're making $100, and all of a sudden gold goes to $1,300. Well, now you're making $300. That's a huge 60% jump in your profit margin. That's why those stocks jump 66%.
So, in other words, what I'm getting from you is that the miners, the producers, if they get their act together, that's what moves the markets first.
Always revenue and cash flow. It's just amazing to see over 12. I like to look at time zones of rolling 12 months or 4 quarters and 12 quarters. So I like to look at those stocks which are showing growth of 1 year over 3 years, and then last quarter over the last 4 quarters. And you get an interesting dynamic of understanding what looks like just short-term noise is actually very profound and significant, positively or negatively, against that 3-year number.
Interesting. So are juniors expensive today? What's causing the lack of mergers by majors? Why aren't they picking up more juniors?
Well, one of the big things with the majors is they need size, and there's been very few 3 million ounce plus deposits discovered. It's unprecedented the amount of money's been spent for the past 10 years looking at gold, and how few high quality, safe jurisdictions that they found big discoveries. So the big money companies that move their dial because they have multi-billion-dollar market caps, they need to have a multi-billion-dollar project to all of a sudden show up on a per share basis it's attractive. So you're seeing the companies like Goldcorp are actually spinning off the smaller mines and taking back that they own 30% of the stock. And that's been a way they've been good at the smaller stock gets re-rated, runs up, and they can sell that stock. Remember, they're the creators of silver wheat with this methodology. So I think that if you have any big projects in the world, you're going to start getting those probably a little later in the cycle. Where the opportunity is in the mid caps and small. So you'll still see mid caps going after small caps. And we saw Eldorado go after Integra. That's a big deal. We're seeing things like that.
Interesting. Let's discuss some of the more unconventional business structures in the industry. Everybody knows that there's exploration companies or companies that have already discovered precious metals or industrial metals, and they're developing and they want to become miners one day. And you got the miners and this is the conventional mining stages. But there's a few sophisticated models like optionality plays or prospect generators, royalty companies, streaming companies. What are optionality companies? What are prospect generators? What are royalty companies? Have they been around since you've been around, or are they newer companies?
Well, it's a great question. The first company I ever took public was Franco-Nevada. So, and it came public in '83 and $2 million run financing, market cap $3 million, and it went to $3 billion. A Newmont merger, and then they bought that out. They spun that out for $1 billion,
that's got to be the most successful mining company ever.
Ever. So when we look at the space, I think that the companies that are out there that we always have to be worried about is this value destruction, and they don't do it with malice or etc. They just do it with just trying to raise money at a low discount rate. And what my argument's been is that they have to have higher discount rates. They can't run, when I just saw a project last week, it's in Ecuador, and it's only a 5% discount rate. I say, well, we wouldn't finance it. We have to take a look at a 12 or 15% discount rate, and your CapEx has to be less than what that discount rate is. And that's lots of technical garbage for you, but it's just really important that you're not spending more money than you're going to get back over the life of a mine. And you have to have a bigger discount rate because there's always so much political risk. There's always many different factors that are coming in the capital markets that create a risk.
Okay. And so are these optionality plays, these prospect generators, the royalty companies, the streaming companies, are they taking on less risks and have potential for bigger gains over the long term?
The smarter ones do this. They go out and they say, here, I'm going to buy 2 million ounces, and it's going to cost me $100 million, but I think there's 10 million ounces. Because our geologists say that the footprint's bigger than this, but we're only going to pay on the net present value of what's known. And that's their optionality. And that's what Franco-Nevada did at the very beginning. And some of those mines lasted, they're supposed to be 10 years, 30 years of production. So I think that's one way. The other way for the small spec stocks is you look for which companies give you the most reserves per share. That's optionality. And so it's understanding that. And then if you want to cherry pick optionality that way, then you look for higher grade, because you can get very low grade that are probably never going to production, but you get lots of ounces per share. But the odds of them going to production are slim. But you start to torque it up a bit by saying, look, I don't want to have 0.1 ounce gold. I want 0.2 ounces of gold. And now give me 5 million ounces. Where is it? It's in Mongolia. Okay, well, it's a higher risk country, but what am I paying for that per ounce? And you can get good value there. And when gold starts to run, they're the stocks that go up exponentially. They also fall when gold falls. Sure,
because they're not economical at low prices, but then obviously everything becomes economical at higher prices. The company gets revalued and they become a target for mergers. Now I want to ask you about this one more question. Do you think the best time to launch optionality companies is during a bear market when you can really find distressed companies and cheap companies?
Well, absolutely. That's the most difficult time. So it's only a very small few people that really understand cycles and understand value. As Warren Buffett says, many know the price of everything and the value of nothing.
Well, that's true. Let's diverse outside of precious metals for a minute. Industrial metals. When you take a look at the fourth most in demand metal in the world, zinc. And I mean, Frank, for almost 3 decades, 0 new discoveries of major zinc mines. How long can this last? And you know what? I have a follow-up question on that. How can the technology for finding oil and natural gas become so advanced, but these industrial metals and precious metals are still so much guesswork?
Well, I think in the last part of your question, it's very difficult to pierce through the hard rock and X-ray. Only Superman can see through rock and steel. So sedimentary rock is different because you can use seismic and get much better information how it reflects back. So I think that's another reason why it's more malleable to move drill bits around through the ground than it is through hard rock. But I think that your other question was, can you repeat it for me, my friend?
Sure. It was about industrial metals important as zinc. And
well, zinc. Okay, so that's a great question. In respect that there's now a thesis that we have peak gold, and there's no doubt we have peak zinc, and any type of pickup in car demand or other galvanized steel. Big construction projects will trigger zinc prices to score and soar. So I think that we're going to continue to see this, and we see the Green Party coming into power in British Columbia. We see it in other places, and that's a religion on its own, and that's a very socialistic model that's pure anti-mining, and it's so dysfunctional. But I think that things like that are going to say, if you have a good zinc project, keep it, because when it pops, it goes up tenfold.
Now, is there any replacement for zinc? Let's say zinc prices go up significantly. Will the world look for any alternative? Is there any good alternative for coating?
No, not really. I'll give you an interesting trivia that the first metal that was used for emissions control was zinc before it became platinum and palladium.
Okay. Interesting. Why does gold mining cost so much more than silver mining? I know we talked about this pre-interview, but can you share a little bit with the listeners why it takes $600 or $700 or even $1,000 to extract gold from the earth, and silver you can do it for $10, $15 per ounce?
It's all about moving dirt, a ton of dirt, and it's how many ounces or fractions of ounces of gold versus how many ounces of silver. And a lot of these silver projects, which appear so much cheaper, they just have many more ounces of silver per ton of rock.
Interesting. Now, GDXJ rebalancing, I mean, what a mess. How did the fund managers not see this coming? I mean, Frank, you're talking professional people. They come in with their suits every day to work. They don't know that they're concentrating positions too much in companies and touching on touchy subjects with regulations.
Well, I think that actually a lot of our active peers do not follow what's in the GDX and GDXJ. They are just oblivious to it. Well, I know we modeled it and we were aware of it. We were surprised at some of the names we got spanked with, like Condex, with a big position in. But which is a great quality company, but they set up to be good buying opportunities, and with this sell-off. So I think it's Christmas time shopping.
So you're bargain hunting among the victims.
Yes.
And you're about to launch your own ETF. Can you share the details, please?
Well, I was working on it for several years now and want to, what they call is machine learning or artificial intelligence. And basically, it's how do you go back and look at all your wins and losses and create, is there a mathematical model that's not black and white? It's a heuristic. And it's a lot like GPS. GPS can't tell exactly where I am within a foot, but it can tell within 20 feet. So it gives you that sort of region around where I'm approximated. The same thing happens with relationships between stocks and headline news and the price of the commodity. There's these interrelations, and you can go back and you can actually create pretty good models from it. And so we went and reviewed all of our case studies, looked at things that are important. As I mentioned earlier in this presentation, it's so important to look at 3 years versus 1 year of data and do this sort of intellectual arbitrage. So if we do see that the past 3 years, what's happened in price to book has been rising and cash flow per share has been rising, that stock's going to outperform those where you're seeing the cash flow decline. And you would think it's that simple to see, but you can sometimes miss it, even quarter changes. So we like to look at 1 quarter over the 4-quarter average to see if it's trending up or trending down. And what we found, if we just took the best 10 stocks, how do they do? If I look for, let's say, a simple metric of who is the cheapest at running their business for the revenue they get, SG&A to revenue. So if I bought just the cheapest 10 stocks of the 88 global gold producers and I rebalanced every quarter, the numbers are just amazing. Like last year, the GDX was up 52%. It was up over 120%, those 10 names. So that's one factor. But when you're running a mutual fund or an ETF, you have to have at least 21 names. And so you have to expand your horizons, and when you're looking at that. The other one was price to book value. We found it's so important to look at book value. Is it rising this last month over 4 quarters? And the same thing with revenue. Is this quarter average above the 4-quarter average? And it's amazing. Headline news may knock a gold stock down, but if it's 1 quarter above 4 quarters, they surge right back. So I want to have something that was intelligent. I've done it with JETS ETF. It's very intelligent, how it's structured, and it's done exactly like the model said it would do. And our particular new product, when we look at the hypothetical index that's on regressional studies, it's on Bloomberg now, we outperform the GDX 95% of the time on rolling 12 months for 10 years.
Yeah, and the ETF will be listed at on the New York Stock Exchange, correct?
Go gold, baby. Go AU, and the ticker's AU.
Okay, well that's fantastic. Now, Frank, I read everything that you publish. You've been around the industry since before I was even born. What are some of the individuals that you've seen rise and shine over the years? How are they able to build company after company while other people, drive companies into the ground? What is between the ears? What are some of the character skills, the attributes of success that you've seen with the superstars?
Well, they have the capacity to be very curious. They're also very driven, and they're curious to learn for themselves. They're very driven to perform at their best, and they surround themselves with young, dynamic, push people. They're really curious about those types of other quality people.
Interesting. If you don't mind, Frank, can you share with us, your most remarkable gain and your most horrifying loss in your career?
I think that the worst one I keep in front of me, is a picture of me smiling with my mining stuff on. I was so happy I financed this gold mine and found out that they had so many problems, and the CEO never told me, and it was so embarrassing. I was 30 years old and I lost $250,000. It was just brutal. So I like to keep the photograph of me smiling there and remind myself every time I get a deal, it may come back to haunt my smile. But then probably that's my, and thank you. And probably one of the best is recognizing that, I did companies like Franco Nevada. It's quality people, and they just perform so well.
Interesting. Hey, looking back, would you say that investing in Buffett-style companies is, just take the same person, same brain power, same willpower, same curiosity, same everything, and you tell him, hey, you can either go the natural resource model, or you can go the Buffett model. Do you think that there will be a difference in return on investment?
Well, that's a good question. I think that the Buffett model is a very slow, methodical model. It's well known, but there's only a few people I know that have actually executed it. I think that some other people have done it in a space like technology, So the individual in Canada has a $10 billion market cap by looking at that type of model, but he buys nothing but SaaS corporations, small ones. And so I think that to me is a way to look at it. But I enjoy, I'm curious. I enjoy the creation of a company. I enjoy meeting new people that are building and doing things. So I think you have to enjoy what you're doing. I enjoy meeting you on our trip to Japan. And I don't think the Buffetts do that like that, that world of how they function. So would I like to do that if it's just money? Yeah, I can always count that up. But does he enjoy his process, the journey?
Totally understand. Okay, what can you tell listeners, given your experience, about how they can tilt the odds in their favor going forward 2017, 2018, 2019 in the resource sector?
What can they do? What?
How can they tilt the odds in their favor? How can they make better choices, better move, better decisions? Some of the key things to look out for.
Well, I think listen to and subscribe to people like yourself who are out there digging up unique information. I think that's helpful. I think that don't overweight. They don't have to go and overweight any one stock or any one category in their portfolio. I think that's another key component. And recognize that half of the success comes from government macro policies, what they're doing. And that's why you have to be in tune with other policies pro-economic development, or are they slowing economic development?
I want to ask you something that's very important. In the last year, since August, most of the mining companies have went either sideways or straight down. And I want to get your opinion on a strategy that I've been lucky enough to excel at myself, and that's to dollar cost average my favorite quality names. It's no secret that I'm one of those investors who believes in optionality plays. Gold Mining Inc., formerly Brazil Resources, and now with the GDXJ rebalancing, I've positioned very aggressively with First Mining Finance with Keith Neumeyer. And on the flip side, I hedge with a short ETF like the Dust or the the GDJS, and that way I'm not net long the miners. Is that something that you also practice?
Yes, we do. You can see in our prospectus we file that we will be using, especially when it's more like technical moving averages, that we will go and buy triple bear if we think gold's breaking down, and put up to 5% of our portfolio, because it's 3 times leverage. And other times, if we have lots of cash and gold's starting to break out, we'll go 3-time bull and then start to sell that off as we buy the individual names.
Now, is that easy? People are very afraid to short. Is that an easy choice to make? Is that an easy execution? Just technically to go in and buy the short ETF?
No, it's easy. I trade millions every day, millions.
Okay. Do you have to use options?
But just have a discipline. Have a discipline, like a simple rule: 10-day high, 10-day low. You come in for 1% and go out for 1%, 10-day high, 10-day low. It allows you to manage your risks.
Okay. Now, do you also use options?
Sometimes we'll do cover writing, and other times we'll buy leaps. Sometimes we bought leaps like on Newmont 18 months ago. We didn't want to own a big position in the stock, but the stock started to take off. What's the best way? So if you have let's say it's 8% or 10% of a gold index, so you just put 1% into leaps, and you get the same type of traction with it, and until the fundamentals say, okay, buy. Because we're very fundamentally driven. So if it doesn't meet our fundamental model, but it's a big component of the index, then we have to make sure we don't get lopsided with it.
Okay. Now, Frank, I know you're very pressured in time. I do want to ask you a little bit about the ETF that you're launching. Can you share a little bit about, I know it's 28 companies, there's a 3, 5, 10, 10 model. Can you go and elaborate a little bit about this? And then obviously we'll have in the description below all the details about the ETF.
The ticker is GOAU. It's listed on New York Stock Exchange. They're ringing the bells next Thursday. As I said earlier, based on all our research and work on it, we put 8,000 hours into it. It's intelligent, it's dynamic, it far outperforms the GDX and GDXJ on rolling 12-month periods. It's very, very impressive that way if you want the exposure. It's only 60 basis points for a very liquid, diversified portfolio. We will highlight more common. What makes it unique and special is that it has 28 names. 3 of them are royalty companies. They're 10% each. And then after that is bigger market cap to mid cap to small cap. The small cap is 5 names at 2% each. And they focus on companies down to market caps of 200 million.
Perfect. Well, to all the listeners, if you think you can beat Frank Holmes, give it a shot. But if not, then you got to respect the guy. He's done everything in this business. He's a very, very successful guy, probably the smartest guy, street smart guy in mining, and he's launching this new ETF. You'll have all the description in the details below in the interview. And Frank, I really appreciate the time. We'll see you soon in Texas.
Take care, my friend. I look forward to visiting with you when you get here. Cheers.
This scramble for junior mining shares really allows for a takeover window of 18 to 24 months going forward. The ETF is basically liquidated out of juniors and bought mid-tier and large cap miners instead. In essence, it breathes life and liquidity into the major producers at the expense of the small cap companies. And I absolutely love it, for this sector always comes alive and attracts funds when merger activity is at high levels, and that's what's about to be unleashed. My eyes were open to the intrinsic value of my top suggestion for this merger mania, First Mining Finance. It's trading now on the TSX in Toronto for FF. The ticker is FF, and on the US side is MGF. And for one of the most serially successful mining businessmen of our era, Keith Neumeyer, the founder of the company, resource investing is about generating revenues. Don't get it mistaken. This guy with First Quantum, with First Majestic, and now with First Mining Finance, he's all about big, fat, and consistent cash flows and thick, monstrous gains. And First Mining Finance was Keith's brainchild. Now, the last financing, in which all the members of the management participated at, the financing was done at 80 cents Canadian, and the company currently trades for less, and this was a recent financing. So this is what will happen in order to unlock the intrinsic value and potential of their assets and generate revenues for the company. First of all, they will start doing joint ventures with cashed up majors. Then they will start doing royalty deals, streaming structures, which we all know is the best business model ever. And they will start spinning out properties for a premium and do some earn-in contracts. When the company signs these value-creating setups, you know as well as I do that the shares will explode fast and hard. Now, I found a pocket of free money because Springpole, the company's premier Ontario, Canada project, contains millions of gold and silver inferred and indicated ounces in the ground, and currently it's worth more in and of itself than the total price you pay for the full package, the company's 25 projects and their $23 million cash hoard. So this is an extreme value moment created by a one-time event which will never repeat. The GDXJ rebalancing took the shares down significantly, and this is served to us on a gold platter, and shares will blast through $1 Canadian soon, as they should. Now, Frank Holmes is gunning the GDXJ Victims Club as well as Wealth Research Group. Make sure you stay tuned for our upcoming interview with Keith Neumeyer himself.